going to begin Chapter 6. And in Chapter 6, we're going to be discussing the concepts and the methodology used to account for merchandise inventory. In our first module, or learning objective, we're going to cover various principles and concepts that relate to merchandise inventory. And this is part, and these principles, we'll keep going back to these periodically, and these are part of our conceptual framework. And the principles we'll be covering in this chapter will be consistency, full disclosure, or just the disclosure principle, materiality, and conservatism. First, the consistency principle. As we said, the principles that we're going to look at are based on the foundation of accrual accounting. And this first principle we'll look at is consistency. Now, consistency is important because it will help enhance comparability, which I'll explain as we go through. Now, the reason why consistency is important is because as we continue through this course, we're going to find out that companies under GAAP, even though you're following GAAP, have choices. Remember, we said that GAAP represents broad guidelines that would provide us with the best alternative or alternative methods out of many possible alternatives. The fact that you have alternatives means that there are choices. So even though you can choose a particular accounting method, so we've already seen perpetual versus periodic systems. In this chapter, we'll see different ways to account for inventory. Here, once you choose a method, that same principle must be applied period after period unless there is a reason, a good, compelling business reason to justify the change. By applying the standards consistently, it allows you to compare the company period after period. And in fact, it helps us when we know the methods that other companies are using to see if we can compare our company with our competitors. So even though there's consistency and a company could change its method, if there is a compelling or a justifiable business reason, that change and its effect on net income has to be communicated to its shareholders in the footnotes. And of course, these footnote disclosures are part of full disclosure, which we'll get to. So if a company makes an accounting change, it can do so if it's justified, but it must be fully disclosed in a footnote. You have to describe the nature of the change and its effect on net income. I would need to know that your income increased or decreased because of a simple change in accounting method and not any change in the economic circumstances surrounding the company, not due to any economic event. So that a change in income that's due to a change in accounting principle must be disclosed. And again, you could see how the concepts are related, that it's related to full disclosure. So, to summarize here, businesses should use the same accounting method period to period. Consistency, as I said, helps compare financial statements from one period to the next for the same company, but it also helps if we know the methods that companies use within the industry. We can compare different companies. And changes in accounting methods, although permitted when justified, must be reported in the footnotes to the financial statements, and that leads us to full disclosure. The disclosure concept, or the full disclosure concept, tells us that a company needs to report sufficient information that allows a knowledgeable user or a reasonably informed user to make decisions about the company. Information, as we said, to be useful, going back to our first look at the conceptual framework, must be relevant and must have faithful representation. The disclosure principle indicates that we must disclose sufficient information. We must be transparent. I mean, that's the word we use now, transparency. It must be transparent that enables users, investors, creditors, stockholders, labor unions. We mentioned all of the wide spectrum of financial statement users earlier in the course, enable them to make rational economic decisions to allocate resources to their most productive uses. So full disclosure means that we must report all information that will influence the judgment, or any information that would influence the judgment, decision making of a reasonably informed user. And that is actually going to take us to something that we might think of as materiality in a few minutes. I mean, again, if you think about the fact that if it's significant enough to influence judgment, then it's material. Here's an example of disclosure, and we are going to get to this LIFO and FIFO in a second, but it does tell you that Green Mountain Coffee is a sample company used in our textbook quite a bit. And it tells you that inventory, it's a sample footnote, inventory of green and roasted coffee, including coffee in portion packs, purchase finished goods, such as coffee brewers and packaging materials, is included in the company's inventory. We stated at the lower of cost or market, which we'll see in this chapter, and they measure it using a method called first in, first out. Okay, and that's just a continuation of the footnote. Now, you have to disclose all information that is significant enough to influence the judgment of a reasonably informed user. Significant enough means that it is material, and that is our next concept. Materiality tells us that we follow GAAP strictly only if the item is significant. It's significant if it causes a change in decision making. In other words, if it's material, it can influence the judgment of a reasonably informed user. For example, many large companies report their numbers in millions. So, cash on the balance sheet might appear as 7,500, but because it's reported in millions, it's actually 7.5000, and the last 6 zeros were left off. Anything below $1 million is considered to be immaterial. So there's $7,500,000,000 of cash, and anything below that amount is considered immaterial. Now that's for a large company. Materiality is a relative concept. Of course, a smaller company would find 7,500 to be material. So again, the best definition, in my opinion, of materiality, it's described as an event or a transaction that is significant enough to influence the judgment of a reasonably informed user of the financial statements. And if it's significant enough, it has to be disclosed. Must be included in the financial statements. Now remember, one of the important things that we mentioned earlier in the course, that financial statements include the statements themselves, and footnotes. So the annual report includes footnotes and the financial statements. Sometimes we just say financial statements in general. And this is part of the full disclosure requirement, or the transparency. Next concept is conservatism. Now, conservatism, in our last concept, conservatism is a principle that states whenever a company or an accountant has a choice between two accounting treatments, we would choose the one that is least likely least likely to overstate assets and income. Conservatism clearly does not mean to purposely understate assets and income. So, for example, on the whiteboard, what we're saying is that when you think about conservatism, you don't want to do something like this. What if you have inventory and let's say it has a market value of 1,000 and it has a cost of 1,200. You would have to report this at the lower of cost or market. You can't show any items on the financial statements that are above what we expect to realize in the marketplace. So in this case, we would have to write this down to 1,000. That would be following GAAP. And that's conservative. But what if you decided, well, you know what? I want to make my inventory even lower. I'll be ultra conservative and I'll report it at 800. So now the inventory is reported at 800. What if you could sell it for 1,000? That would automatically give you a $200 profit. So if you are over conservative, it is just as inappropriate as being overly optimistic. By reporting inventory at 800 when its market value is 1,000 allows you to release profit later on when you sell it. Sometimes these are called hidden reserves. When you understate assets purposely, later on you're going to overstate income. So understating asset and income purposely is not really the proper way to apply conservatism. So again, conservatism does not mean to purposely understate. So to summarize, a company should report, and this does not mean the least favorable, but it just means when there are two or more options. So make sure this is very clear that it is when given alternatives, you'd like to select the one that is least likely to overstate assets and income. And again, you try to avoid overstating assets, but you don't, that's the objective of conservatism, but you don't want to be overly conservative. So what conservatism might do for us in application would be, well, we don't anticipate gains. We provide for all possible losses. So let's say on a lawsuit or litigation, if a company's being sued and there's a good chance that it's probable that there's going to be a loss, it should be recorded. Gains, however, we have to wait typically until they're actually realized. Conservatism will be also applied to assets and liabilities. We don't want to overstate assets or understate liabilities. When in doubt, we expense rather than capitalize. So, for example, and I'll put this up on the whiteboard in a second, what do you do if you have an expenditure? Is it an asset or is it an expense? And we choose options that will undervalue the business when given choices. Again, you don't purposely undervalue, but when given choices. So going back to the whiteboard, basically, when we think about a choice, I mean, companies could do the following. I mean, what if you had $5,000 of supplies? Now, those supplies are going to be used over several accounting periods. However, what if you decide to expense it? That would lower income. The other choice would be to record or capitalize as an asset. And we cover this in detail when we looked at the various deferrals. So again, the choice here, if you expense it that might be over conservative, and when you capitalize it, it may not be conservative enough. It really depends on the fact, or whether or not you have the facts, whether or not those supplies will be useful for more than one accounting period. Now, this is the conceptual framework part of the chapter. We're going to go to Module 2, which will cover the inventory valuation. And in that inventory valuation, we'll determine what inventory valuation methods give us the most conservative inventory or the most optimistic inventory.